Hello, and welcome to Simple Finance Bytes. I'm Ernest, and this podcast is my letter to my younger self about money, the practical strategies I wish someone had taught me when I was starting out. We focus on simple finance because simple finance systems get used consistently, while complex systems get abandoned when life gets busy. Today, we're starting a new topic, building real wealth through simple systems that actually work in the real world, and I'm going to show you how. Before we jump in, if these episodes are helping you, the best way to support the show is by subscribing and leaving us a review on Apple Podcasts, Spotify, YouTube Podcasts, or wherever you listen. Then, share it with someone who needs to hear this content. Connect with us on social media. We're on Instagram, Threads, and Facebook, and we'll be expanding to a few other platforms in the not-too-distant future. All the links are in the podcast description, show notes, and on our website at simplefinancebytes.com. If you want to stay connected with our Simple Finance approach, make sure you're signed up for our free newsletter at simplefinancebytes.com. Each month, I share simple finance tips that don't make it into the podcast. Plus, I call out financial industry tactics that keep people confused. Most people think wealth building requires complex strategies, multiple investment accounts, and perfect timing. Simple finance works differently. Simple systems that you actually stick to beat perfect plans that you abandon. Let me start with why most wealth building advice doesn't work for regular people. The financial industry sells complex wealth building strategies because complexity sells products. They make money off of it. They want you to believe you need 7 different investment accounts, perfect asset allocation, and constant rebalancing. But here's what actually happens. Complex systems work great on paper, but they fall apart in real life. It is very difficult to track multiple investment accounts while also managing your day-to-day money. When you have too many moving pieces, you stop paying attention. When you stop paying attention, you stop contributing. When you stop contributing, your wealth building stops. This happens over and over. The person who invests $500 monthly in one simple account beats the person who has the perfect allocation across 5 accounts, but only contributes when they remember to. When I first started investing, fortunately, this wasn't a problem for me. Back when I started, we didn't have all of the opportunities that are available today. We didn't have free commissions, or we couldn't execute free trades on platforms like Fidelity, Schwab, Vanguard, Robinhood, Wealthfront, Betterment. Every single trade had a price attached to it, and it usually ranged from $5 to $25. So we had to be very careful and very judicious about where we did our investments. So in that case, having only one account made sense, and it was the right way to go. It still is today. It's just that today you can be bombed by all these advertisements for all these different products and all this stuff that the financial industry is trying to sell. But you need to think simple. You need to simplify. Even though you can buy and trade stocks for free today, that doesn't mean, it's a free for all. We're going to do whatever we are allowed to do. Find a single account and do it there. And when I say a single account, that doesn't mean literally you can only have one account. Most people who have regular 9-to-5 jobs, they get a paycheck, a direct deposit, have the ability to have either a 401k from work, or maybe you have a Roth IRA that you opened at your brokerage like Fidelity or Robinhood, and you can have a regular taxable brokerage. Pick any one of those, and even if you have all 3, that's okay. Just make sure that you have your stuff being automated going into them, meaning you have a certain percentage of your paycheck going into your 401k at work and being automatically invested into a broad market index fund. You're not having to remember that, and it's being taken out before you actually get your paycheck so you don't mess it up. Same thing for the Roth IRA. You can contribute to that once a year. You don't have to do it monthly, but doing it monthly makes it easier so you don't forget you have an automatic investment going there. So the key here is make it simple. If building simple wealth systems resonates, but it feels overwhelming, I work with people one-on-one to make this practical. SimpleFinanceBytes.com has the details. Simple works, complex doesn't. Wealth building strategies should make your life easier, not harder. Now, let's talk about what actually builds wealth for regular people. Simple wealth building starts with one basic idea. Spend less than you make, invest the difference, repeat for decades. Let me repeat that one more time. One basic idea, 3 parts. Spend less than you make. This is the most important one. Invest the difference, right? So whatever you don't need, you invest, and repeat that for decades. This is long-term wealth building. And that's it. Everything else is just details. The investing industry doesn't want you to know how simple this is because simple doesn't sell expensive products. But research shows that people who follow basic principles consistently outperform people who try to optimize everything. Here's what simple wealth building looks like in practice. You have your emergency fund set up. You're investing a fixed amount every month into simple investments. Again, 401k, Roth IRA, whatever it is, fixed amount every month into simple investments, and you're living below your means without being deprived. And that's also key. If you feel like you're being deprived through this entire process, it makes it easier for you to give up. If you automate everything and you don't feel like you're being deprived in the process, it's very easy for you to keep it going. The key is making it automatic. When wealth building happens without you thinking about it, it actually happens. When you have to remember to do it every month, life gets in the way. Now, as far as living below your means without feeling deprived, I'm not saying not to buy anything. I'm saying you can buy whatever you want as long as you can afford to buy it cash outright. This keeps your wealth building on track because you're not paying interest to other people. And that's crucially important. When I was younger, this was probably the hardest lesson for me to learn. It wasn't that I couldn't buy things. I could buy whatever I wanted. I just couldn't buy everything. I had to figure out that I had to be able to afford it cash outright. Because when you can't afford it cash outright, you buy it on a credit card and you start paying insane interest rates to someone else. You're making that individual or that bank rich. Flip the script. You want to be the one that gets rich. So this is part of what we call the prepaid lifestyle, which is you buy anything you want. If you want to buy a $100,000 car, that's fine, as long as you can afford to buy it cash. That's the key. So always focus on the prepaid lifestyle. Be able to afford it cash before you actually buy it. You have an emergency fund. If there's an emergency that happens and you need to pull cash out, say to replace a tire on your car or get your car repaired in the event that it breaks down, that's different from, hey, I want these new sneakers that cost $250, or I want a new iPhone that costs $1,000. If that's your thing, go for it. Buy it. If it brings you happiness, buy it. Just make sure you can afford to buy it cash outright. That's the important part. Now, if you want help setting up automated wealth building that actually works, check out my one-on-one coaching at simplefinancebytes.com. Simple works because you can actually do it consistently. One of the most important parts of wealth building is knowing your target. And this goes for anything in life. Always know your target. If you don't know where you're going, you can't tell if you're making progress. If you can't tell if you're making progress, there's no way for you to measure it. It's easy for you to just sit back and say, well, I'm doing what I said I was going to do. I will get there. Know your target. Once you know your target, now you can actually measure progress and make sure you're actually on the way to where you're trying to get to. Simple Finance makes this easy with basic math. Take your annual expenses and multiply those by 25. That's roughly how much you need invested to be financially secure. Now, when I say annual expenses, you have to think rent or mortgage, although when you retire, you may not have a mortgage, so consider that. But for this example, let's say rent or mortgage, your utility bills, insurance that you must have, like health insurance or auto insurance if you drive a car, food, all those kinds of core things that you need to survive. Those are your annual expenses, and multiply those by 25. You don't need to count in things like the entertainment you do, going on trips. That's all extra and you'll account for that later. But as far as figuring out what your number is, it's your annual expenses and multiply by 25. Let's say you spend $40,000 a year. Your wealth building target is about $1 million. If you spend $60,000 per year, that's about $1.5 million. This isn't perfect math, but it's good enough to give you a target. Remember, this is a target. This isn't like an exact thing that you have to land right on that target. You're going to aim for that target and you're going to try to get as close as you can. Sometimes if you're lucky, you'll overshoot the target. That's even better. But here's the deal. Perfect calculations that you don't use are worthless. Simple calculations that guide your decisions are valuable. And that's what the target is. It's a simple calculation that guides your decisions. Once you know your number, you can figure out your timeline. If you need 1 million and you're investing $1,000 per month, you can estimate how long it'll take. We'll cover that a little bit later. The timeline helps with motivation. When you know you're 20% of the way to your wealth building goal, it feels different than just hoping you're making progress. Now, I want to talk a little bit about how calculating my wealth building number changed my perspective and how it can change your perspective and your motivation. The first thing is, as you know, I'm a semi-retired engineer. We have a phrase called boiling the ocean. And what we mean by that is you take on too big of a task and there's no way to actually get it done. You're setting yourself up for failure. It's one thing to boil a pot of water. It's nearly impossible to boil the ocean unless you're the sun. So do not let the numbers scare you away. When you have a target of $1 million, when I started out with this and I looked at it and I said, I'm going to need $1.5 million to retire, that's a humongous number. I couldn't even conceive having that kind of money. But that's because I was thinking of it in terms of my salary and trying to literally put aside a certain amount every month to hit that target. But the reality is when you're investing, the market is doing the work for you. You still have to invest, but the market is doing the lion's share of the lifting to get you to that number. Early on, you're doing most of the lifting, but as compounding happens over time, then the market starts doing the work for you. That is what we call passive income. That is truly passive income, not the kind of stuff you see online, people scamming people on social media to start selling their MLM junk insurance products. This is real passive income. So don't let the numbers scare you away. They're just targets. You're going to aim for them and let the market do the work for you. Compounding is something that is amazing, right? I think it was Ben Franklin who said, it's the eighth wonder of the world, compound interest specifically. So what that means is when something compounds, it's adding to itself. So let's say you have $100 and you invest it into something that compounds at 10% annually, like the S&P 500 or a full total US stock market index. What that means is if you put in $100 at the beginning of the year, at the end of the year, that $100 has turned into $110. You did nothing. The market did that 10% uplift. Now, assuming you never put another dollar in, that next year, that $110 compounds, and instead of adding $10, it adds $11. So now you have $121. 21%, right? It went up in 2 years. Do you see where this is going? So now imagine that with $1,000 or $10,000. You're investing every single month. So you're putting in a certain amount every month, and every month that stays invested, that's compounding at that annual rate. This is the reason that the market is so powerful and compounding works the way it does. The amount you contribute in the beginning is the majority of the money you're going to have in your retirement account. But the total at the end are very different. You'll find out, again, if you do this over a long period of time, say 30 years, let's say you start at 30 and you're going to retire at 60. That's 30 years. I'm actually encouraging 20-year-olds to start and retire at 59 and a half in a Roth IRA. That's 40 years of compounding. They will be a multimillionaire if they do it correctly starting at 20 years old. At the end of that 30 or 40 years, you're going to find that the amount you actually contributed into that retirement account is small, maybe 20%. And the other 80% came from the market doing the lifting for you. So the younger you start, the easier it is to hit the target with just maxing out a Roth IRA. The younger you start, the easier it is. Again, the younger you start, the easier it is. However, even if you're 30, 40, even if you're 50, it doesn't matter. Do it anyway. Why? Imagine that you are 50 years old and you know that 67 is the full retirement age where you can finally start drawing your Social Security. It seems like that's only 17 years. That's not enough time for compounding. It is. And even if you only put $1,000 a month in, you have 17 years at $1,000 a month compounding. Even if that doesn't get you to your target of $1 million or 1.5, it gets you way closer than if you do nothing. So the answer here, or rather, the best way to look at it is, even if you don't hit your target, it is still absolutely worth it for you to try to hit that target. Because when you do retire, you will have way more sitting in that account than you would have otherwise. It's kind of like when you go to the gym, right? You can't lift extreme weights right away. It takes you time to build it up. Even if in your mind you're aiming to be Dwayne "The Rock" Johnson or Arnold Schwarzenegger, and you never actually make it to that target, it doesn't matter. Where you got along the way, health-wise, you are way better than had you done nothing. You will live longer because of those choices than if you had done nothing. So remember, this is a target. Aim for it and go. Calculating your specific wealth building plan can get complex, but I can help you figure it out. I can help you figure out realistic timelines through my coaching program. SimpleFinanceBytes.com has all the info for that. And remember, simple math beats perfect calculations that overwhelm you every single time. Now, the final piece is making wealth building happen without willpower. Willpower runs out. We're human. Everybody knows that. Willpower runs out. Automatic systems don't. They do not stop unless you stop them. It's probably another thing to point out here. You can stop if you need to, right? If life throws you a major emergency, hey, I'm a huge fan of saying life happens. Life will humble you. If something happens and you need to pause, you can pause. But make that the exception. Don't make your mind have to remember all this. Automate it. Willpower runs out. Automatic systems do not. Set up automatic transfers from your checking account to your investment account. Pick a day after payday when you know the money will be there. Start with whatever amount feels comfortable. You can increase it later. One of the things I always advise people to do, especially with their work plan, if they're using their 401k, and again, that varies person to person, but if you are using it and say your company offers you a 6% match, my recommendation is always take the 6% match, but that's it. Put the rest into the Roth IRA and then some additional into a taxable brokerage if you need to. But one thing you can do that's kind of cool is to increase that contribution amount by 1% every year. And that's because typically you're going to get a raise every year and it's usually going to be 3% or maybe a little bit more. So if you're constantly increasing your rate 1% per year, so instead of 6% this year, next year it's 7%, you won't notice it, but you'll be building wealth faster. Now, the amount matters less than the habit. $100 per month that happens automatically beats $500 per month that you have to remember to do and inevitably forget it because, again, life happens. Life is busy. Most people think they need to optimize their investment choices first. It's not true. Simple Finance works the opposite way. Start investing consistently, then worry about optimization later. Your investment choices matter, but not as much as actually investing. The person who invests in okay investments consistently will build more wealth than the person who researches perfect investments but never starts. And this is where I always get into the discussion of stock picking versus buying broad index funds. Broad market index funds like VTI from Vanguard or VOO from Vanguard, which are the US total stock market or the S&P 500, those are thousands of stocks and hundreds of stocks respectively. They're all good selections. You don't have to do anything. The fund manages itself. So you just worry about consistent investing versus the person who's trying to figure out, is Coca-Cola a good buy? Is Nvidia a good buy today? What about Microsoft? I heard Apple's doing great. That person's going to be paralyzed. Even worse, they're going to invest into those companies. Those companies are going to have a miss on their quarterly earnings, And because they're picking individual stocks, it's going to be a huge drop to their portfolio value. Versus if you invest in the total stock market, if a handful of companies have a bad quarter and their stock value goes down, you're not even going to notice it. This is why automation works. It takes the decision making out of wealth building. Instead of should I invest this month, it becomes how much extra can I invest this month? As I mentioned earlier, when I first started out doing this, and again, it's very different when I started versus what it is now, I was trying to pick individual stocks, and I was trying to pick the ones that weren't, the high flyers at the time. Because again, I was coming right out of the dot-com bust. So I was trying to pick decent, reasonable stocks, and it took forever to figure out which ones I was going to invest in. And I basically spent a lot of time spinning my wheels. Yes, at the end of the day, I was making more than I was losing in these transactions. So I was growing my wealth, but it was nowhere near what I could have done had I just invested in broad market index funds. And that's really what all of this comes down to. Using broad market index funds and automating everything changes your entire perspective on wealth building. And then it keeps you from having failures due to manual systems. This is so important. It's a lesson I had to learn the hard way. And it's one of the main reasons I started this website and this podcast, is to give that information to you, because you will always see stuff online about picking stocks and trading stocks and buying this and crypto and that. And hey, if that's your thing and that's your hobby and that's your passion, I'm not going to tell you not to do it. I am going to tell you not to do that for your retirement. You can do that with your gambling money, so to speak, right? Whatever you want to do with it, it's your money at the end of the day. But if you're investing for retirement, that's not the way to do it. Simple, automated investments in broad market index funds will win over the long term. I read a statistic the other day. It was something like 95% of professional active fund managers fail to beat the index. Let me break that down for you. What that means is 95% of professional stock traders, investors, fund managers. So these are people who manage an entire stock fund. They have a whole team of analysts. All these people have, Ivy League college degrees and access to the best computing power that money can buy to try to figure out what stocks to buy and how to trade stocks within their fund. 95% of them cannot beat the index over the long term. The index being the S&P 500 or the total US stock market index. Now think about that for a second. This person is charging insane commissions to the people investing in their fund. They're actively trading stocks on a daily, if not weekly or monthly basis. They have an entire team of people. All of these people are making multiple six figures, and they cannot beat the index over the long term. That's embarrassing. But what's worse is they're still doing it and they're still charging people for that. So don't fall for that. Simple investments in broad market index funds, automated. That's what matters here. Now, setting up automated systems that actually work for your situation, that might seem confusing. I can help you figure it out. Go to simplefinancebytes.com, click on the section that says one-on-one coaching, and let's talk about it. But at the end of the day, simple systems that run automatically beat complex systems that require perfect execution every single time. Let me give you the key takeaway from today. Simple wealth building systems that you actually use beat perfect strategies that sit on paper. Most people think wealth building is complicated because the financial industry profits from complexity. But simple finance works differently. Spend less than you make, invest the difference automatically, repeat for decades. I'm going to repeat that one more time. Spend less than you make, invest the difference automatically, repeat for decades. It's really that simple. Now, one thing I do want to talk about, and we have talked about it before, but I'm going to put it here in the closing section again as a reminder, is to stay away from get-rich-quick schemes. This is slow wealth building over time. That's what we do here. If you hear people use phrases like generational wealth or breaking generational curses, those are huge red flags. You're probably walking into an MLM insurance scam. So just be careful. Again, generational wealth, generational curses. If people are talking about insurance in the same sentence as wealth, huge red flag. Also, Ignore junk insurance products like indexed universal life and whole life insurance. Those products have their place, but they're not for 99.9% of people. However, they're being sold on the internet like they are. That 0.1% is literally the 0.1%, not you and I. Those are designed to make the insurance companies rich while greasing the palms of the unethical agents who sell them. Ignore people telling you that a house is an investment. This is one of the biggest things I see on social media. A house is not an investment. It is a shelter. It is a roof over your head. That's it. Yes, it has a value. Yes, it can build equity over time. It is never going to build the same amount of equity that stocks do in the stock market. It's not an investment. It's a shelter. Actually, it's a liability at a certain point because you have to start repairing it and you're paying property taxes and homeowners insurance and all that stuff. It's a roof over your head. Ignore people telling you that a house is an investment. And lastly, stick to simple broad market index funds and ultra short-term U.S. Treasury bills, VTI or VOO and VBIL. Again, our system covers all this. If you have any questions, feel free to reach out to me on social media or through email, info@simplefinancebytes.com. I'll be happy to answer the questions for you. Your wealth building plan doesn't need to be perfect. It needs to be simple enough that you'll stick with it when life gets busy. Thanks for hanging out with me today on Simple Finance Bytes. And a quick note, this is all financial education, not financial advice. So please see the full disclaimer in the show notes before making any financial decisions. If this episode was helpful, subscribe and leave us a review on Apple Podcasts, Spotify, YouTube Podcasts, or wherever you listen. Then share it with someone who needs to hear this content. For more insights on simple finance and building real wealth, head to simplefinancebytes.com. And if you want the deeper insights behind these episodes, plus your free Simple Finance System blueprint, join our monthly newsletter. It goes out the first of every month. Connect with us on Instagram, Threads, and Facebook. All the links are in the show notes. And if you found yourself thinking, now I know what to do, but I need help making it automatic, reach out to me. I can help you with that. Before we wrap up, a quick security reminder that applies to everything we've discussed today. Enable two-factor authentication on your email and banking accounts right now if you haven't done it already. It's the simplest way to protect the wealth you're building. Also, freeze your credit at all 3 credit bureaus if you haven't done it already. That's the number one way that identity thieves and identity theft happen. Your future self will thank you for this 5-minute investment in security. Until next time, keep it simple, stay focused, and take control of your financial future.